Welcome to the Deeper Dive, the show that unpacks the why behind the market's what. I'm your host, Alex.
And I'm Christine. It's great to be here.
Christine, it's fantastic to have you back. Today, we are tackling a story that has captivated and frankly terrified investors for the past 6 months. We're looking at a titan of the modern era.
Right.
A company that put binge watching into our vocabulary.
Yes.
And we're asking why its stock has been in, well, a downward spiral. We are, of course, talking about Netflix.
That's right, Alex. From its peak in late June 2025 to where we are now at the start of January 2026.
Wow.
The stock has shed nearly 30% of its value. I mean, for a company that was, for a decade, one of the safest bets in tech.
Yeah.
This kind of sustained slide is deeply unsettling for the market.
It is. And whether you're a seasoned trader or just, someone with Netflix in your retirement fund,
Right.
a drop like that demands explanation. Our mission today is to connect the dots, to go beyond the panicked headlines and build a clear narrative of how this happened. Let's begin our deeper dive. So, Christine, let's set the stage. Take us back to the middle of 2025. What did the world look like for Netflix then?
In many ways, Alex, the world looked pretty good. The business itself was fundamentally strong. If you look at their Q3 2025 report, you'll see some impressive numbers.
Okay.
Revenue grew 17% year over year, and free cash flow was robust. And their big strategic moves, cracking down on password sharing and launching the ad-supported tier,
Right.
they were proving to be successful revenue drivers.
So it sounds like the engine was running smoothly, but the market is a forward-looking machine. What was the ghost in that machine? What was the underlying anxiety?
The anxiety was about the future. The core problem is what analysts call market saturation.
Right.
Netflix is already in most of the homes it can easily get into in its key markets. That explosive, seemingly endless subscriber growth that defined its first 2 decades, that era is over. So the billion-dollar question hanging over the stock was, where does the next phase of growth come from?
A question that demands a powerful answer. And that answer, when it came, would shake the very foundations of the company and the market. This brings us to Chapter 2. In early December 2025, Netflix delivered its stunning answer to that what's next question.
And it was a seismic shock. They announced a definitive agreement to acquire the heart of Warner Brothers Discovery, its film and television studios, HBO and HBO Max, for an enterprise value of around $82 billion. And to be clear, this wasn't a simple content licensing deal.
No.
This was Netflix attempting to swallow a huge piece of Hollywood's soul.
Let's unpack that. For $82 billion, what exactly was Netflix getting? What was the strategic thinking?
They were getting a treasure chest, the world-class Warner Bros. Studios,
Okay.
the entire revered HBO library, think Game of Thrones, The Sopranos, Succession.
Right.
They were getting massive global franchises like DC Comics and Harry Potter. The logic was really a brute force calculation. In the brutal streaming wars, unique, can't-get-it-anywhere-else content is the ultimate weapon. Netflix decided to stop renting its weapons and just buy the entire armory.
A bold, almost imperial move to secure its dominance for the next generation. So how did Wall Street, the ultimate arbiter of these moves, react?
Wall Street recoiled. The stock began to bleed almost immediately. The first-order effect was a crisis of identity. Investors saw a company that had always preached the gospel of nimble, organic, tech-driven growth,
Right.
suddenly making this heavy, debt-fueled legacy media acquisition. It felt less like a visionary move and more like a defensive one.
And just when investors thought the plot couldn't get any thicker, a new villain entered the scene, turning a risky deal into a full-blown corporate nightmare. Which brings us to Chapter 3. The ink was barely dry on Netflix's press release when another player stormed the castle.
Precisely. Paramount Skydance, in a move straight out of an HBO drama,
Unbelievable.
launched a hostile, all-cash tender offer for Warner Brothers Discovery, and their bid wasn't just a polite counteroffer.
Wow.
It was a jaw-dropping $108 billion, blowing Netflix's offer out of the water.
So, in an instant, Netflix's grand plan is thrown into chaos. What are its options at that point?
They're all terrible. Option 1, engage in a bidding war that makes an already astronomically expensive deal potentially company-breaking. Option 2, walk away with their tail between their legs. But walking away wasn't free. The deal structure included a poison pill.
Oh no.
A massive $5.8 billion breakup fee payable to Warner Brothers if Netflix failed to complete the acquisition.
It's a classic checkmate scenario. They're facing the possibility of either massively overpaying for the asset or paying billions of dollars for absolutely nothing.
And that's the core of the market's terror. The market hates uncertainty above all else.
Always.
And this saga became the very definition of it. It also threw a spotlight on the huge regulatory risk,
Yeah.
with political figures suddenly making public comments about whether the deal would create an unfair monopoly.
This was the moment the theoretical risk became a tangible, stock-crushing reality. Which leads us to Chapter 4. With a bidding war raging, regulators circling, and a multi-billion-dollar breakup fee looming, how did the professional analyst community, the people paid to make sense of this, respond?
They responded with a flood of downgrades. We saw influential firms like Rosenblatt and Pivotal Research slash their ratings from buy to hold. The central argument was about return on invested capital, or ROIC. The spreadsheets just didn't work. I mean, analysts simply could not build a credible financial model. Where this deal, especially at a higher price, would generate a positive return for shareholders in any reasonable time frame.
I also heard whispers of a ghost being resurrected on trading floors, the ghost of AOL Time Warner.
Exactly. For any investor with a sense of history, the parallels were chilling. A high-flying new media tech company buying a legacy media giant at a massive premium,
Right.
right at a moment of market uncertainty. That 2000-era merger became the textbook study case for corporate hubris and value destruction. And the fear was that history was about to repeat itself.
But Christine, it feels almost too simple to lay this entire 30% collapse at the feet of one dramatic deal. Were there not other deeper cracks forming in the Netflix fortress long before this dramatic deal? Let's peel back the headline-grabbing layer of the Warner deal. What else was happening in Netflix's kingdom?
The kingdom was facing a multi-front war. The streaming landscape is no longer a monarchy. It's a brutal, feudal battlefield. Disney Plus, Amazon Prime Video, and even YouTube are carving out significant territory. And while Netflix remains the biggest player,
Sure.
Netflix's share of viewer attention and engagement has been steadily eroding.
And the cost of fighting that war keeps escalating, doesn't it?
It's staggering. Netflix was projected to spend around $18 billion on content alone in 2025. When your content budget is larger than the GDP of many countries,
Wow.
Netflix's pressure to deliver global, culture-defining hits every single quarter is immense. For every Wednesday or Squid Game,
Right, the big ones.
there are dozens of incredibly expensive films and series that launch and just vanish without a trace. The ROI on that content spend was under more intense scrutiny than ever.
So it feels like they were caught in a strategic trap. To compete, they had to spend astronomical sums on content.
Yes.
But that spending was pressuring their margins and still wasn't guaranteeing the growth Wall Street demanded.
Exactly, which in a way is what pushed them toward the Hail Mary pass of the Warner acquisition in the first place.
That's the perfect way to frame it. It's a vicious feedback loop. The era of easy growth was over. Every available path forward, whether through creating more of their own content or buying someone else's, right?
Was now suddenly fraught with colossal expense and risk. So the 30% stock decline wasn't just a reaction to a single deal.
No.
It was the market methodically repricing Netflix for this new, far more difficult reality.
So as we stand here today, we see a company at a profound crossroads. Its audacious attempts to secure its future has, in the short term, completely torched its present market value. It's a gripping, cautionary tale about the burdens of being the king.
It truly is. The coming months will be critical. We'll find out if this saga was a moment of temporary, ambitious overreach,
Yeah.
or the beginning of a long-term structural decline for a company that defined an entire media era.
Now, here's a question we'd like you to think about.
As the lines between tech and media companies blur into nothing, Netflix tried to solve a tech problem,
Right.
slowing user growth,
The core issue?
with a media solution, buying a 100-year-old studio. As you look at the other giants of our economy, where else do you see this fundamental clash of corporate DNA playing out? And who do you think has the right strategy to win?